What's up, everybody? Investing Club here, back with another video. In this video, I want to go over the real reason why stock prices move up and down and what actually drives the change in stock prices over the long run. The website I'm on right here is Fast Graphs. I highly recommend everyone checks out this website. You can get a 2-week free trial. And what this website is good at is showing the relationship between the fundamentals of a stock and the stock price. And the stock I have up here on the screen right now shows a perfect example of this. This is a Amerisource version, stock that's been around for a while. It's a medical distributor. And what you see here are, on this graph, you have an orange line and a blue line. The orange line essentially represents the earnings at a PE ratio of 15. So the orange line is how much money the company is making each year. And what you see is, and the black line is the price of the stock. And what you see is the black line almost perfectly follows the earnings line over time. Right? The earnings are low down here, so is the stock price, and as the earnings go up, the stock price almost perfectly tracks this. Now, of course, it's not going to always perfectly track it. There are going to be periods of overvaluation and undervaluation. And remember, in the short term, price doesn't follow how much money the company's making. In the short term, stock prices are driven by two emotions, fear and greed. When people get greedy, people buy and the stock price goes up way above what it should be. And when people are fearful and get scared they're going to lose all their money, they sell, and that drives the stock price way under its true value. One big problem that a lot of people have is they seem to invest at the wrong time. So we'll go back in history here. There's clear periods where the stock, like right here, the stock price is over what the earnings are, and that is a clear overvaluation. So let's say you invest right here in 2007, and we see all the way here in 2009, you are down 18.5% in 2 years. And this is a clear consequence of buying the stock while it's overvalued. You could see the same thing back here. You buy it right around 2002, and it's about 3 years before you even break even. We can see it again more recently. This went crazy recently, 2015, you buy the stock all the way down up here, and still 5 years later, you're still underwater. Now, again, but conversely, there's also times where the stock is undervalued. Like right here would be a good buying opportunity. And right now, currently, is also the stock is trading below its true value. This is just a stock I randomly chose, but I really want people to, if you want to get better at investing, I want you to take advantage of this tool because I've used it and I've found it immensely helpful to analyzing stocks. We can look at another company. Here we go, another company. We have Ascena Retail Group, and as you can see, it's the same thing. The stock price follows the earnings or how much money the company is making, but we can see that what happened in 2013 and onwards, this company tanked. They started making less and less money, and now they don't make anything. And what you see is the stock price went all the way from $400 to where it is now at $7. And the point I'm trying to make here is that stock price follows the earnings line both ways. Just as easily as the stock goes up when the earnings go up, the stock price will crash if the company stops making money. And this is why it's important to invest in good companies that you're confident in. You could invest in this company right here and say, okay, it's not overvalued, but I mean, if you're not confident that they're going to be able to keep earning this much in the future, you're putting your investment in jeopardy. So now we can take a look at another company, and this one is one that I'm personally invested in myself right now. It is Bank OZK. And again, what you see is the stock price closely follows the earnings line, but right now we are in a period of severe undervaluation. And there are a couple of reasons for this. Historically, the growth rate has been consistently growing for earnings, but recently we saw a drop. Even though earnings are expected to continue growing, this drop in earnings really scared off some people and made the stock price fall from $48 all the way to 28. And so I think that this is a very good buying opportunity for this company. And there's this website has a bunch of awesome tools. We can go to, this is performance. You can see how much the dividend growth rate has grown if you're primarily a dividend investor. This is probably my favorite tool, the forecasting tool. You can see once the stock returns to this earnings line of where it normally trades at, you can see, you can see how much your return can be. You can approximate it based on the projected earnings. And, see, so according to this, by 2021, I could make a 54% return, which is pretty cool. Additionally, you have the analyst scorecard. And so a lot of companies have estimates for earnings, but it's important that these estimates are accurate. And so this tool right here shows you for Bank OZK, earnings 1 year estimates for the next year are hit 100% of the time, and they're beat 36% of the time. Earnings estimates for 2 years out are only missed 18% of the time. So you can see that the estimates that are given to this company have been very accurate historically. We can go to, just for reference, we can go to another stock I have off the top of my head. And, this is not a company you want to be investing in, because as you can see, even if analysts are estimating that the company is going to grow earnings, their estimates aren't right 2/3 of the time for the next year, and pretty much the same for 2 years out. Back to OZK here, and so this is what you guys should do when you're investing and you're looking at a stock. You should see where it is, where the price is in relation to the earnings line and the line where it typically trades at. This is the main idea of value investing, that, in the short term, price goes up and down almost randomly. But once in a while, you'll see a stock like this fall so far from where it's supposed to be trading, and you could assume that is these lines up here, and you could buy it at a nice discount. So this is the real factor that makes stock prices move. If you're ever in business school or you study finance, you're going to have teachers tell you that the market's always efficient and that it's not really possible to buy undervalued securities because everything's always fairly priced. I beg to differ, and so do some of the most famous investors in the world. So obviously this is not all you want to do when you look for stocks. You can't just see a chart like this and say, okay, I'm going to invest. A lot of the times there's a reason for this decline and deviation from the normal stock price. Maybe there is a lawsuit, or maybe there are, tariffs that the company does a lot of business in another country. So the job of you guys when you do research for stocks is to look into the reason why stock prices fell from their normal trading valuation and see if the reason justifies the price falling that far. The idea for this kind of graph was made by Peter Lynch in his book, and I highly recommend everyone reads it. I think it's a great read for anyone who wants to become a better investor. It really helped me out, I'll tell you that, and I'll put a link to it in the description. So just a quick recap to wrap up this video. Stock prices are determined by how much money the company makes, also known as the business fundamentals. And even though the PE ratio isn't useful by itself in isolation, and I'll put the video I made on that in the description, historically you can see that most companies trade around you can call it a normal PE ratio, where they stay around. And so based on that, you can find potentially undervalued stocks and use those to make outsized returns. Thanks for watching this video, everyone. Be sure to like and subscribe, and I'll see you on the next one. Bye-bye.